In the venture mindset, Stanford professor Ilya Strebulaev and technology executive Dang explore the principles and practices distinguishing venture capital from traditional corporate thinking. Strebulaev and Dang emphasize the importance of risk-taking, long-term thinking, and flexibility, contrasting the venture mindset with traditional approaches that stifle innovation. They discuss the significance of betting on the right people, accepting failure, having diverse networks, and making informed, quick decisions. They aim to help leaders apply these principles, showing that even traditional environments can benefit from the venture mindset. Bet on boldness. In November 2012, venture capitalists Sachin Deshpande, Patrick Egan, and Nagraj Kashyap considered investing $500,000 in Sosby, a startup aiming to revolutionize video conferencing. Introduced by Silicon Valley angel investor Bill Tai, Kashyap met Sosby's founder, Eric Yuan, who previously worked at WebEx. There was tough competition from WebEx, Skype, Google Hangouts, and others, but Yuan claimed his product was superior. Deshpande, impressed by Yuan's knowledge and the product's performance, invested $5 million. Egan, also impressed, saw Yuan as a technical virtuoso with sales skills. Kashyap led Qualcomm Ventures, the investment division of the technology company. The Qualcomm Ventures team, however, was skeptical due to the crowded market, the Chinese-born founder's imperfect English, and the high valuation. Qualcomm had a side pathway for riskier investments, allowing Egan to invest $500,000. Sosby, later renamed Zoom, became a massive success, especially during the COVID-19 pandemic. When Zoom went public in 2019, Qualcomm owned 2% of the company. Zoom's success is part of a broader trend of venture capital backing revolutionary companies such as Apple, Google, and Tesla. VC funds, though small compared to the overall financial system, play a crucial role in funding and supporting startups. The venture mindset has driven significant innovation and economic growth. The venture mindset differs greatly from traditional corporate thinking. It has evolved over decades through trial and error, especially in Silicon Valley. This mindset has led to the success of many startups, disrupting or creating new industries. Traditional mindsets fail in high uncertainty environments, unlike the venture mindset, which embraces disruption and innovation. Corporate leaders often fear disruption and fail by treating innovative ideas like any other business unit. Embrace failure. In early 2013, Fab.com, a promising e-commerce startup, sought funding from top VC investors. The company, founded in 2010, had impressive growth, reaching 1 million members in 5 months and 10 million by December 2012. It generated more than $100 million in sales within 18 months. Famous VC firms such as Andreessen Horowitz, also known as A16Z, and Menlo Ventures had already invested $40 million, valuing the company at $600 million in July 2012. However, Fab.com failed spectacularly in October 2013, laying off most staff due to high cash burn and failed acquisitions. VCs expect frequent failures but aim for home runs, where one big success covers all losses. They diversify their investments, knowing most will fail but a few will yield massive returns. This mindset helps them navigate a competitive environment where only a few startups succeed while the rest fail. The 3M company invented Post-it notes, which generate more than $1 billion annually for 3M. This success was accidental. In 1968, 3M was developing a strong adhesive, but a weak, pressure-sensitive adhesive was accidentally created. It was shelved until 1974 when inventor Art Fry found a use for it as a sticky bookmark. This led to the creation of Post-it notes. 3M's culture of innovation and tolerance for failure has been key to its success. This mindset also led to the invention of Scotch tape and ace bandages. However, in 2000, CEO James McNerney introduced the Six Sigma program to reduce costs and improve efficiency, which some stakeholders believe stifled 3M's creativity. Six Sigma focuses on reducing variability and defects, which works well in predictable environments but not in creative ones. Researchers Mary Benner and Michael Tushman found that Six Sigma shifts focus from radical to incremental innovation. The venture mindset and Six Sigma both have merits, but their effectiveness depends on the situation. Encouraging bold ideas and accepting failure is crucial for innovation, while Six Sigma is better for efficiency in stable environments. Changing organizations is hard. Large companies face systemic hurdles but can succeed with well-designed processes. Startups have limited resources and high failure risks, while larger organizations can run many experiments and survive failures. Innovative companies such as Apple and Amazon blend risky and traditional investment. Amazon's 2014 Fire phone failed, but Jeff Bezos embraced failure, leading to Echo, Amazon's successful smart speaker. Companies should view investments as a pyramid: core businesses at the bottom, adjacent innovation in the middle, and disruptive innovation at the top. Serendipity and Networking. A $1,200,000 check covered a lot more than dinner at Pane e Vino, an Italian restaurant in San Francisco, back in September 2007. The large check included a relatively small seed-stage investment in a company called Evenflow Inc. That early investment in an unknown technology startup turned into a $2 billion return in about 10 years. The check was written by Sequoia Capital, one of the most famed VC investors in Silicon Valley. The fledgling company later became known as Dropbox, a popular service for sharing files. The investment deal was made over dinner between Samir Gandhi, who was then a partner at Sequoia, and the company founders, young MIT graduates Arash Ferdowsi and Drew Houston. Innovation leaders in large companies prioritize internal sources. VCs with small offices and limited internal resources must look externally for new ideas. Corporate leaders often focus on incremental improvements from a limited pool of internal ideas rather than seeking fresh, transformative ideas externally. In contrast, VCs review numerous startups annually to make a few investments. VC connections can be surprising. In 1996, executive coach Bill Campbell connected investor John Doerr of Kleiner Perkins to Leslie Koch, the marketing director at a fledgling startup called Amazon. This led to a major investment. Philip Winter met Apple CEO Tim Cook in a gym, leading to Cook investing in Winter's showerhead startup, Nebbia. VCs often dismiss unusual ideas, but successful ones are open to diverse encounters. Familiar networks can be limiting. Diverse backgrounds bring fresh ideas. VCs pursue startups, attend events, and use AI to find opportunities. Cold pitches can be effective. A study found that 1 in 12 emails to VCs received a positive response. Traditional organizations often ignore cold emails, but VCs see them as potential gold mines. David Cowan of Bessemer Ventures missed investing in Google after dismissing 2 Stanford students, Sergey Brin and Larry Page. Investor Gary Tan responded to a cold email about Bitcoin, leading to a $300,000 investment in Coinbase, now worth over $500 million. Serendipity plays a role in discoveries, and VCs stay open to cold pitches. Disruptive technologies such as Xerox's xerography, a scientific term for a dry photocopying technique, faced initial rejection but later succeeded. Steve Jobs and Steve Wozniak were handed similar rejections before Apple became a trillion-dollar company. Internal innovators often face rejection within their own companies. Additionally, the not invented here syndrome, where companies reject external ideas, is common. Studies show large firms often ignore external innovations, and managers favor ideas from their own divisions. Nordal, a Canadian multinational telecommunications and data networking equipment manufacturer, missed opportunities in cellular technology and smartphones due to this syndrome. Xerox's Palo Alto Research Center Park Lab created groundbreaking inventions such as the 1973 Alto computer, but failed to commercialize them. The syndrome acts like an immune response, protecting organizations but also hindering innovation. Organizations must change this mindset to embrace disruptive ideas. Networking is crucial for innovation. Diversifying networks and seeking ideas externally can lead to groundbreaking innovations. Evaluate opportunities. Each year, Stanford MBA students act as VC partners, deciding on real startup investments. Students must choose one startup to invest in, using limited information and quick judgments. VCs often use the red flag approach to quickly reject startups with critical flaws. This method is similar to how people choose restaurants or hotels by eliminating options with negative reviews or high prices. This approach helps VCs manage numerous opportunities efficiently. VCs succeed by preparing extensively in specific areas, allowing them to recognize promising startups quickly. Samir Gandhi's knowledge of file sharing led him to invest in Dropbox, and Greg McAdoo's understanding of vacation rentals helped him see Airbnb's potential. This is what Ilya Strebulaev and Alex Dang call the prepared mind approach. It enables VCs to make swift, informed decisions, often appearing as gut instincts, but backed by extensive research and experience. Venture investors aren't the only ones who benefit from prepared minds. Microbiologist Alexander Fleming's discovery of penicillin happened because he was ready to notice a mold-killing bacteria. Years of work prepared him for that moment. Similarly, Steve Jobs saw the potential in Xerox PARC's technology because he had spent years thinking about computers. Xerox executives missed this because they lacked the venture mindset. Xerox leaders didn't capitalize on its innovations due to a lack of interest and understanding. Their main business was printers and copiers, and they didn't prioritize PARC's breakthroughs. For example, PARC's computer mouse cost more than $350 to make and didn't work smoothly. Jobs commissioned a team to design a $15 single-button mouse that worked on any surface. VCs can spot promising startups quickly because of their prepared minds. The idea that 10,000 hours of practice makes an expert doesn't apply here. A broad perspective is more valuable. Traditional companies often suffer from analysis paralysis, delaying decisions. The venture mindset relies on being prepared and moving quickly. Prepared minds can quickly identify opportunities, but they must avoid biases. Being prepared means recognizing patterns and making informed decisions, not relying on shortcuts or ignoring facts. Be selective. In a game, participants must guess the number of coins in a piggy bank. They make bids, with the highest bid winning what's inside. If the piggy bank has $30 and someone bids $20, they win if no one bids higher, and they're ahead $10. However, if they bid $40 and win, they end up losing $10. Strebulaev and Dang often use this game in corporate workshops, and the winner always has bid much more than what's inside. The game illustrates the winner's curse, showing how people will overpay due to uncertainty. This phenomenon is common in VC and mergers and acquisitions. Fear of missing out can lead investors to overestimate a startup's value. The winner's curse worsens with more bidders and time pressure. Biotechnology investor Bill Maris of Google Ventures avoided investing in Un2known, now a defunct company, by scrutinizing its board and testing its product. His skepticism saved him from a bad investment. Other VCs also rejected the Un2known after detailed due diligence. VCs filter opportunities. They quickly reject most ideas and thoroughly investigate the few that pass initial scrutiny. This process helps avoid bad investments. Detailed due diligence, often taking hundreds of hours, is crucial for making informed decisions. Investment memos are concise tools that weigh pros and cons, identify risks, and spark debate. They are not meant to convince, but to inform and stimulate discussion. This approach contrasts with traditional corporate exercises that often champion unfounded optimism. VCs, often seen as risk takers, actually focus on reducing risks through thorough due diligence. They assess management, business models, and market conditions, consulting a wide range of sources. This mindset has been adopted by Amazon, which uses structured documents to evaluate new ideas. Memos help identify risks early and facilitate retrospective analysis, improving future decisions. Unlike traditional corporations, which can be slow and bureaucratic, VCs make quick, focused decisions. Traditional organizations often get bogged down in incremental changes and miss disruptive innovations. R.H. Donnelley, once a multi-billion-dollar corporation, failed to adapt to digital disruption and went bankrupt in 2009. Its main product was the Yellow Pages. Being selective and systematically rejecting most opportunities is crucial. This approach is not limited to VCs, but can be applied in various contexts, from hiring to home buying. Saying no often and focusing on high-potential opportunities is key to success. Bet on the right people. Ollie Tamiseb's book, Super Founders, explores what makes startups successful. He analyzed data from thousands of startups and interviewed more than 100 unicorn founders. Super founders are those with prior successful startups. Tamiseb's research shows these founders are 3 times more likely to succeed. He invests in advanced technologies through his VC firm, DCVC, trusting the skills and background of super founders. In the early 2010s, the gaming industry boomed. Marcus Persson sold his game Minecraft to Microsoft for $2.5 billion. Supercell, a gaming company, raised $12 million and later reached a $3 billion valuation. Excel Partners, a VC firm, invested in Supercell and TinySpec, a startup. TinySpec's game, Glitch, failed despite significant investment. However, Excel believed in the team and encouraged them to pivot. This led to the creation of Slack, a successful communication tool later sold to Salesforce for $27 billion. VCs prioritize the team over the product. Strebulaev's research shows that 47% of VCs consider the team the most crucial factor. Successful companies often pivot. VCs invest in people, not just ideas, believing execution is key. This mindset contrasts with traditional organizations that focus on processes and business plans. A product code named Project Caribou started as a joke, inspired by a Dilbert cartoon. Initially, one person built the prototype in a day, and the team grew to just 12 before launch. Promising users 100 times more than any other product for free seemed absurd. It launched on April Fool's Day 2004 as Gmail. Gmail, now used by nearly 2 billion people, began with Paul Butchheit, Google's 23rd employee. It was a startup within Google, running on a server at Butchheit's desk, with feedback from Google engineers. Gmail's success wasn't just due to Butchheit, but also to Google's leaders, who created an environment for innovation. Unlike startups, internal projects compete for resources and attention. Google's leaders provided broad support and oversight, allowing Butchheit to explore ideas freely. Google News and Google Scholar also started as small projects. Google's venture mindset encouraged internal startups, allowing talented employees to take risks. This mindset, combined with a supportive environment, led to successful products. Successful entrepreneurship involves motivated teams, broad support, and the ability to pivot. Leaders must nurture and support these internal entrepreneurs to drive innovation. VCs also consider market size, business model, and product. Andy Rachleff, co-founder of Benchmark Capital and Wealthfront, notes that a great team in a bad market fails, but a great team in a great market succeeds. Market size is crucial. VCs invest only if the market potential is huge. Established firms rely on processes and standard operating procedures. This traditional mindset values processes over people. Traditional companies often fail to recognize and act on new opportunities, focusing instead on routine projects. Netflix places people over process, trusting employees to innovate. Co-founder Reed Hastings believes in giving people freedom, leading to successes like House of Cards. Netflix's success also involved timely market bets and a solid business model. Robert Langer's lab at the MIT Department of Chemical Engineering fosters entrepreneurship, encouraging researchers to explore independently. Langer's approach led to the success of Moderna, which he co-founded in 2010. Betting on people and their passions can lead to groundbreaking innovations. Encourage dissent. In an experiment in South Africa, vervet monkeys, living in groups, were given pink and blue corn, with one color made bitter. They avoided the bitter corn and stuck to the other color. Even when the bitterness was removed, they continued eating the same color, teaching their young to do the same. Migrant monkeys quickly adopted the new group's corn preference, showing the power of group influence. A classic experiment by Professors Bibb Latané and John Darley demonstrated the bystander effect. When alone, people reported smoke filling a room, but in groups, they often did nothing, influenced by others' inaction. This highlights how groupthink affects decisions. In a VC class, students in groups made investment decisions. There was little disagreement within each group. Dominant voices often swayed the group's direction. High-performing VC firms avoid unanimity, fostering debate and disagreement to make better decisions. Unanimous decisions often lead to poor outcomes, especially in uncertain environments. A consensus-seeking culture can be as harmful as one that avoids decisions. VCs embrace disagreements and don't seek consensus. They argue, listen, and kick ideas around, often leading to better outcomes. Contrarian investments can lead to significant gains. John Maynard Keynes, one of the most famous economists of the 20th century and a contrarian investor, outperformed the market by 4 times by investing in stocks instead of following the traditional endowment strategy. VCs use small teams for decision-making, ensuring everyone contributes. This approach enhances communication and accountability. Junior team members often speak first to avoid the influence of senior opinions. This practice encourages valuable input from less experienced members. VCs also assign a devil's advocate to argue against deals, ensuring all perspectives are considered. This practice helps avoid groupthink. Collecting independent opinions before meetings further reduces bias. VCs eventually converge on decisions, but they value dissenters who challenge the majority view. Encouraging dissent drives innovation and prevents conformity, ensuring better decision-making in uncertain environments. The veto right allows certain individuals to overrule decisions. Nagraj Kashyap, after leaving Qualcomm, started M12, the venture arm of Microsoft, and insisted on anti-veto power, allowing investments even if opposed by him. This led to successful investments such as Kahoot, a game-based learning platform. Partner Brian Roberts at Venrock introduced a process where the deal champion makes the final decision, preventing missed opportunities. Venrock partners debate deals, but one partner decides. Founders Fund and a16Z also allow partners to make decisions without full consensus. VCs debate and seek evidence before making decisions, addressing biases throughout the process. Focus on promising ideas and cut losses early. Richard Herrock, an experienced poker player and managing director at Vantage Point Capital Partners, believes poker skills help in VC decisions. In Texas Hold'em, the most popular style of poker, players collect the best combination of 5 cards out of 7. The game involves betting and decision-making with incomplete information. VCs use similar strategies, starting with small investments and deciding to fold quit this round, call match a bet made by another player, or increase the bet as more information becomes available. Traditional organizations often wait for all information before making decisions, risking losing momentum. Smart VCs value flexibility, making decisions step by step, similar to poker players. This approach allows them to adapt and succeed in the long run. Flexibility, known as real option in finance, means having the right but not the obligation to take future actions. This concept is crucial for the venture mindset, where shutting down failures and supporting successes is key. You can't play it too safe, however. A16Z invested $250,000 in Instagram early on, but didn't continue funding, missing a bigger return. Real optionality is vital in the pharmaceutical industry, where most drug candidates fail and companies must decide whether to continue or stop projects. Mining also relies on this flexibility, adjusting operations based on market prices. Hollywood uses real optionality by adjusting marketing budgets based on a movie's opening weekend performance. My Big Fat Greek Wedding started with a limited release and expanded as it gained popularity. Decision makers must react to new information to survive and succeed. This mindset involves making small investments and doubling down later rather than committing fully upfront. Escalation of commitment, where people continue investing in failing projects, is a common bias. Executives often make poor decisions due to personal attachment to initial investments. VCs mitigate this by involving partners in follow-on decisions, ensuring unbiased perspectives. Lightspeed Capital uses a reinvestment team to challenge follow-on decisions. Bringing in external experts helps companies make better decisions and avoid escalation of commitment. Smart VCs also seek new investors to avoid escalation of commitment. Founders often need new lead investors for subsequent funding rounds. This isn't about lack of capital, but about maintaining objectivity. Storied software VC firm Hummer Winblad rarely invests in follow-on rounds without new investors. Many companies miss the value of external perspectives. Bringing in outsiders can provide crucial insights. Only about 1 in 60 VC-backed startups becomes a unicorn, a successful company valued at more than $1 billion. VCs give startups enough capital for 12-18 months, expecting milestones to be met. Mark Andreessen, co-founder of A16Z, likens VC investments to buying a portfolio of long-dated call options, focusing on promising ideas and cutting losses early. Google X uses a serial killer model to weed out ideas, with only 3% making it to the foundry step, where the goal is to test the idea as a business. Flexibility is crucial in careers and education. US universities allow students to explore different subjects before choosing a major, unlike their European counterparts. Flexibility helps navigate uncertainty, much like poker players deciding to fold, call, or raise. Incentives. Dobromiro, a Croatian slave, was freed after his Venetian owner's death. His son Pancrazio helmed a ship. Pancrazio's son, Zaccaria Stagnario, became one of Venice's wealthiest men. His rise began in 1199 with a contract from Giovanni Agatti, who gave him 300 pounds of Venetian pennies for trade in Constantinople. The contract stipulated that Stagnario would return the capital plus 3/4 of the profit, keeping 1/4 for himself. This profit-sharing model was a key medieval business innovation, enabling capital-less merchants to engage in profitable but risky long-haul trade. Centuries later, the whaling industry in New England mirrored this model. Whaling required significant startup capital and was highly risky. However, it offered enormous returns. Whaling agents connected capital owners with skilled captains. The agents got a share of the proceeds, as did the captain and crew. Modern VCs use similar incentive structures, aligning interests through limited partnership agreements. This model ensures that everyone involved in a venture shares in its success, driving hard work and innovation. Economists often use lottery-style experiments to study risk preferences. Choosing between a guaranteed $40 or a 10% chance to win $400 shows whether someone is risk-neutral, risk-seeking, or risk-averse. McKinsey and Company researchers asked 1,500 managers how they would handle a $100 million investment with a chance to return $400 million or lose everything. Most managers required a 60% chance of success before they would make the investment, showing high risk aversion. This contrasts with startup founders who might take more risks due to different incentives. A payoff chart can explain this behavior. For a startup, if the value exceeds the investment, founders gain significantly. If a startup sells for $35 million after raising $25 million, the founders get $10 million. Founders might choose riskier projects because they stand to gain more, unlike corporate managers, whose compensation doesn't change much with project success. Incentives drive behavior. Corporate managers prefer safer projects due to their fixed salaries and potential penalties for failure. Startups incentivize risk-taking for potential high rewards. This difference in incentives explains why managers and founders make different decisions. The venture mindset encourages aligning incentives to promote risk-taking and innovation, making everyone a shareholder to grow the pie rather than just seeking a larger slice. This approach has been successful in both technology and traditional businesses. Long-term thinking. In 2006, Elon Musk's SpaceX had a failed rocket launch due to a fuel leak. Despite multiple setbacks, SpaceX persisted, finally succeeding in 2008. This led to significant investments, transforming SpaceX into a leader in space launches. By 2022, SpaceX had launched 61 rockets, surpassing government agencies despite having a smaller budget and team. SpaceX's journey exemplifies the venture mindset, which involves betting on long-term trends despite short-term failures. This mindset is crucial for industries facing disruptive changes. The venture mindset thrives during crises, seeing opportunities where others see risks. This approach has led to the success of Uber, Airbnb, and Tesla, proving that long-term thinking can yield extraordinary results. Strebulaev became the most popular dad at his daughter's elementary school when she mentioned he was a leading unicorn expert. Unicorns in this context are VC-backed companies valued at more than $1 billion. Silicon Valley venture capitalist Aileen Lee coined the term in 2013, identifying only 39 such companies. Today, there are more than 1,000 unicorns. Their combined value surpasses the GDP of India and Brazil. Unicorns are significant because their value can exceed that of entire publicly traded companies in some countries. However, these investments are illiquid and often unprofitable for years. VCs must be patient, waiting for a liquidity event or exit to see returns. The initial public offering of the data analytics software company Palantir took 16 years. Many unicorns take more than a decade to go public. VCs endure long periods of losses before seeing exponential growth. But the average unicorn exit valuation is $4 billion, 20 times the capital raised. Patience and long-term thinking differentiate VCs from traditional investors. Long-term thinking changes behavior, making short-term losses acceptable. VCs invest in future technologies, such as space tech and driverless cars, focusing on potential rather than immediate profits. This mindset contrasts with that of traditional investors, who prioritize short-term gains, often missing out on transformative opportunities. VC-backed companies avoid the pressure of quarterly results, focusing on long-term goals. Jeff Bezos emphasizes long-term thinking, which allowed Alexa to develop over years. Kaspi.kz transformed from a traditional bank to a tech company with a super app that combines payment services with e-commerce and financial products, showing the power of long-term vision. The marshmallow experiment by Stanford psychologist Walter Mischel showed that children who delayed gratification had better life outcomes. Long-term thinking is crucial for career decisions and avoiding short-term traps. Embracing the venture mindset. In 2018, a group of executives from the Stanford Executive Program visited the first Amazon Go store in Seattle, experiencing a revolutionary shopping experience with no lines, cash registers, or cashiers. This visit inspired Tomasz Blicharski, who later launched the first cashier-less store for Żabka, a leading Polish retailer. Under his leadership, Żabka Nano stores became a European leader in autonomous shopping. Żabka's success showcases the power of technology and the venture mindset. Traditional companies can compete with startups by adopting this mindset. To stay competitive, companies must update their mindset, just like updating a smartphone operating system. Training leaders in the venture mindset can spark innovation. Mindset matters for building future-proof companies.